Hi everyone, this is Financial JC, episode 2, dollar cost averaging versus lump sum investing. I think I'm about to settle one of the biggest debates in investing, a debate that could cost you tens of thousands of pounds if you get it wrong. If you get it right, then you're going to see the upside to that. So let's pretend that you've just received a windfall, inheritance, bonus, redundancy payment, or you've finally saved up 50, 100 grand or more, or less. Now you're facing the question, should you invest it all at once or spread it out over months and years using dollar cost averaging? So why does it matter? The difference between these two strategies can be 50 to 100 grand over a 20-year period. One approach wins 75% of the time, but the other provides better peace of mind and downside protection. So today I'm going to show you when to use each strategy and the psychology behind why most people make the wrong choice and how to optimize your approach based on your specific situation. So Vanguard actually, who are much bigger and much more important than I am, they did this study a number of years ago. Who's better off after investing 100 grand? All right, and this is data from the US, UK and Australia. They compared a lump sum, investing a lump sum immediately versus dollar cost averaging over 6, 12 and 36 months. And what they found was that lump sum investing beats dollar cost averaging approximately 75% of the time, across all time periods and markets. So when we look at the actual numbers, okay, 100 grand invested day one, assuming 7% returns after 10 years, that'll give you £196,715. Dollar cost averaging, when you split that over 12 months, so £8,333 invested per month, gives you a value after 10 years of £189,542. Difference of just over £7,100. That's 1 year dollar cost averaging. All right. The longer you spread out the investments, the larger the opportunity cost typically becomes. Here's the question though. If lump sum investing wins 75% of the time, why do so many people go down the dollar cost averaging route? And it's all about the psychology, not maths. It's the psychology behind the choice. And the reason DCA, I'm going to call it DCA now, it's easier, feels safer is because it has all to do with psychology and nothing to do with the actual return, right? So you've got regret, aversion. We hate the idea of investing everything right before a crash, and then the thought of losing 20 to 30% up here plays havoc with your mind. Then you have loss aversion. So behavioural finance shows that people feel losses twice as strongly than they do compared to gains. So a 10 grand loss hurts more than a 10 grand gain, in the way that a 10 grand gain makes you feel good, so a loss makes you feel 10 times worse or twice as worse. Recency bias. If markets have been volatile, people assume that they're going to continue to be volatile. Been rising, they've worried about buying at a peak, and then the whole buy the dip comes into play. Analysis paralysis. When you're making a large investment decision, it's easier to spread it out over a period of time rather than commit to one moment in time. The illusion of control as well. DCA makes you feel like you're doing something active and it's smart, even though mathematically it doesn't actually make sense. These factors often lead people to make poor financial decisions. That's why people need a financial advisor. We choose a strategy that feels safer rather than one that actually performs better. Understanding the psychology in this is crucial, because if you can't stick to your strategy, then the optimal approach becomes worthless. For example, people that are on good on DCA route, when the market's volatile, they probably want to have a month off. I'll sit out this month, it's a bit too choppy. You've seen it happen. And then people don't do anything, they sit there and don't do anything, they spend it. You then got the time horizon as well. The longer the timeline, the more likely a lump sum is going to beat dollar cost averaging. I'll tell you why. Because short-term volatility becomes irrelevant over decades. Okay, then have your risk tolerance for volatility. If you can genuinely handle seeing your investment drop, think of COVID, where in March 2020 markets dropped 30% without panicking, then again this might be for you. Okay. Market trends, you can't predict short-term markets, you can't predict short-term movements. Okay. Earlier investment captures more upside, obviously, but again you can't time it. But over time, any chart you see goes like this. Okay. Now, in terms of your tax advantage accounts, maybe some people that are in the UK that are watching this. Obviously, you have your ISAs and your pensions with like annual contribution limits and things like that. For expats, you've got a number of different options like offshore investment accounts and offshore bonds and things like that, which are all fit for purpose in this instance. For the younger investor, in your 20s, 30s and 40s, you've still got decades to recover from any short-term volatility anyway. So time is actually your biggest advantage, not dollar cost averaging. You need to make sure that you have a diversified investment strategy. So the funds you're buying are broadly the same, so maybe it's not diversified. So again, that's where you need help to make sure that the diversification is there, but also the correct amount of weightings are there as well. You need to understand the opportunity cost as well. Okay, so leaving money in the bank, it's just going to lose purchasing power to inflation. So when does it make sense? When does dollar cost averaging make sense? Okay. Extreme market valuations for one. So you've got if stocks are historically high, like high PE ratios, high price to book ratios, things like that. Spreading the investments over time can actually provide you a bit of protection. It's then about like anxiety about the timing. So if the thought of investing a lump sum is keeping you awake at night, spreading that out over a period of time will give you not necessarily mathematical benefit, but it will give you peace of mind. In volatility, we were volatile in the markets, 2008, COVID 2020, DCA can help you avoid timing decisions. All right. If you're new to investing, again, I would probably recommend that you start with dollar cost averaging. Help you build confidence. It'll help you learn how to react to market movements as well. When you've received a large windfall, that's relative to your net worth. So if the lump sum that you've received equates to 50%-ish of your net worth, then perhaps spreading that risk out would make sense in terms of portfolio balancing. And then you've got the economic conditions. So recession fears, geopolitical instability, major economic transitions, dollar cost averaging can help. Okay. The behavioural side of things as well. Now this is where you start to learn about how the market works and how you actually react in market events. And again, spreading out the risk is sometimes not a bad thing. Regular income. If you just claim, right, I'm going to save 20 to 25% of my salary each month, I'm just going to drip it in to an investment account, then that's actually quite a good and quite a sensible thing to do. The mathematics behind lump sum investing and why it works, okay, markets actually rise most of the time. In fact, any chart you look at, the markets will always be going up over a period of time. 70-75% of the time, any given day, month or year, the market's up. This means that any delay in investing is going to cost you money. And you've got the cost of holding cash. So while DCA is great, inflation's sitting at 3 to 5% in some cases. Cash actually losing purchasing power. We all talk about compounding growth as well, obviously. So every month you delay investing is a month loss of compound growth. With a 7% annual return, 10 grand invested today is worth £700 more than investing in it next year. Okay. Volatility reduction. Dollar cost averaging doesn't actually reduce the volatility of your portfolio. It just delays when you experience the volatility. 100 grand is still going to fluctuate. As much whether you invest it all today or spread it over 12 months, it's still going to go like this. You just need to zoom out, and again, not to labour the point, but look at things long term. I use this thing called the wall of worry from Humans Under Management. It's very, very good. All my clients have seen that wall and they understand the investment journey. It's all about education, really. So then, when you start to look at like the best of both worlds, what does that look like? So most advisors will say to you, no, it's this or it's this. Well, you can actually do both and just take a bit of a hybrid approach to it. And it's something that I do quite a lot of with my clients, that they establish an account with a lump sum, and then they want to contribute to that every month for a period of time. Okay, so you'll have what you call like your core and satellite funds. So the core fund is exactly that. That might be a lump sum where you invest the vast majority of the assets into the core, with the other payments each month, and the ad hoc payments go into the satellite funds. But you can also top up the core fund as well if you wanted to. So you can also what we call the tranches strategy, where you have like 3 or 4 tranches. And you're like, right, when the market reaches this, I'm going to invest Y. And you can do things like that, and it's always worth speaking to a financial advisor for the best way to make that, because it requires a lot more like active management, but you can optimise the timing as well. And obviously for the guys in the UK, you've got your like tax year end where you maximise your ISAs, you maximise your pension contributions and things like that. Okay. From a psychological perspective, you could start with a small lump sum that you're comfortable with, and then dollar cost average everything else, the remainder. This builds like confidence while capturing some of the early market exposure. And the key really is matching your approach to your psychology with the market conditions and the financial situation. So for expats, you've got a wide choice of options really. You've got tax efficiency through pension transfers, investment accounts, offshore bonds, and a couple of other recommendations that we're able to make. What you need to consider is market conditions and timing considerations. So a bit of guidance on market conditions should influence your decision. Bull market favours lump sum investing. You want maximum exposure to like ramp up the gains. Actually, when you're dollar cost averaging in a bull market, it actually ends up costing you money. Bear market is actually where dollar cost averaging really reaps the rewards, really, because obviously you're buying everything at a discount. When there's a lot of volatility in the market, dollar cost averaging can help you smooth out those like swings in price, but only if you're disciplined. If you shit the bed, then like dollar cost averaging isn't going to be for you really. Market valuations, when ratios are high, dollar cost averaging, again, like I said before, will actually give you a bit of protection. Economic uncertainty as well, like recession fears, economic transitions. Again, like psychologically, it can be quite difficult to still commit to contributing to an investment account every month. What else have we got? Interest rates. So opportunity cost of holding cash is lower. Simple as that. Dollar cost averaging is then more attractive. Okay, but what's really important is that timing all of these points is nearly impossible. The best thing to do is just to invest and just carry on investing until you reach your goal. That is genuinely the best thing to do. So a lot of mistakes that I have seen: overthinking market timing. There's nothing worse that a financial advisor can hear than "I want to time the market," because you can't. If we could time the market, then we'd all be like Warren Buffett and be not doing this job. So you can't time the market. All right. Extending out dollar cost averaging. I've spoken to some people that are like, I'm dollar cost averaging my portfolio over 15 years. Like 15 years. This is ridiculous. It's not that longer term. Okay. Confusing that as well with regular investing. Investing from your salary is different from actually spreading over a lump sum, because when you invest in your salary, that's like very rigid. Like, right, I'm doing 10, 15, 20%. With a lump sum, right, I've got 100 grand, I'm going to do 25 this month, 25 next, 25. It's coming miles apart, but you need planning to make sure that everything is working in your favour. People ignore tax, expats ignore tax. Obviously in UK you've got like your ISAs and your pension contributions, which are fine, but for expats, like, this is incredibly important, is making sure that your investment accounts are actually as efficient as they possibly can be. All right. People sometimes overanalyze as well. They want the perfect plan. There's no such thing. Things change, markets move. Nobody knows what they're going to do. And if anybody does tell you that they know what the market's going to do, they're lying, and I would run a mile. So again, people overanalyze what they have, and they want to, like, everyone wants to become a millionaire overnight. You don't become a millionaire overnight. You become a millionaire by staying committed and riding out volatility. Okay, and looking at your timeline, your experience volatility, market conditions, your tax, and building a financial plan around that. So most people make this choice based on their gut feeling or generic advice that they read online. With this amount of money that's at stake, you need a strategy that's specifically designed for you, your situation, and what's up here. Mathematical evidence favours lump sum investing in most scenarios, but if you can't stick to a lump sum strategy, we don't have the funds, it's absolutely fine. Dollar cost averaging can help you build that up, and it'll give you results over a period of time. The most important thing to do is to make a decision and then stick to it. Worst outcome you can do is just sit on cash for months or years where you debate the perfect strategy. I've seen that happen. You need to analyse your situation, your risk tolerance, your timeline to determine the optimal approach for your lump sum investment. You must model different scenarios, factor in tax, and design a strategy that maximises your returns while you're matching your psychological comfort level. Don't let analysis paralysis cost you years of potential returns. What you want to do is sit down with a financial advisor and come up with a strategy that works for you. It's got to be sustainable, it's got to be suitable. Okay, so I'm going to leave you with that. Thank you so much for watching, and I shall see you next time.